Have you ever wondered why a government will go deeply into debt and then turn around and almost in the same breath tell you to put a bunch of money into tax deferred plans for retirement? Has that ever made you wonder maybe possibly we're being manipulated? Hello, my name is Mark Willis, certified financial planning professional, and your host for today's quick idea bomb that I wanted to go through with you. I get this question a lot. In fact, I just got it yesterday from a client on the phone. We were having a Zoom call and we were going through a conversation about tax deferred financial plans, everything from 401ks, IRAs, 403bs, all of the regular ways that we put money aside for the future. And they were concerned that the government was running up major deficits. And yet they were maxing out their 401k contribution, putting in as much as they could every single year. And they said, it doesn't make sense mathematically for me not to let my cash grow compounded on money pre-tax. They said, if I pay my tax, then put it into a Roth IRA or some other vehicle after tax, I have less money to invest. And therefore, I'm going to have less money to spend in retirement. I'm going to prove that wrong today. I'm going to show you guys with math that is absolutely not true. And really what matters most is where will taxes be in the future? If taxes are going to be even 1% higher in the future, it mathematically makes more sense to pay our taxes today than to wait till the future. So again, stick with me to the end. You're going to see exactly how the math shakes out and proof that whether it's tax deferred or tax free, what matters most is when do we pay our most taxes? I want to pay my taxes on the amount that's due. I don't want to leave the IRS an unnecessary tip. So let's get into the content of our talk together today, and I'll share my screen with you guys. So we honestly got to be honest here. Every economist would agree, I think, we have a major tax problem in this country. It's funny to kick around the IRS, put the word the and IRS together, and you get the word theirs. But the truth is, the IRS is doing a great job. They're doing what's necessary to support a nation that's got a major spending problem. With the IRS, we'd be even in worse shape than we already are. Well, it's really fascinating by all of today's standards. Before we had an IRS, the United States actually posted surpluses in the federal budget. Now, call that ironic or whatever, but the IRS started, the income tax started as a temporary program in 1913 to cover the war. And really it became more permanent as we got into World War I. It was really just a way for the government to replace other revenue sources, like getting rid of tariffs and so forth. And they put a permanent tax on their own citizens. So since then, as you can see, we've had a major increase in our tax, followed by a trending downward scale here. As you can see, in 1913, we had a really low income tax, followed by a dramatic increase as we went into the 20s, and it shot up amidst the Great Recession and into the 40s to pay World War II, and then the New Deal that was proposed. And again, many other programs like the Great Society and others really shot up the tax rate to a full 91% of your taxes on income earned. The government would tax 91% of your top tiered income. Unbelievably high in today's standards. If you go back even in times of the serfs in England, serfs only paid 25% of their income to their feudal lords. So let that sink in for a minute. In the land of the free, we have a season in our nation's history where we were giving more than serfs were to our government. That's just unbelievable. And honestly, so taxes have since come down dramatically and have been historically low for the last 35 years, as long as I've been alive, really. Many young adults don't even remember a high tax environment in this country. And that's got to feel like great news. In fact, you look at this chart and you say, hey, it's low taxes for the rest of our lifetime. No doubt. We can continue to put away, pay our taxes now because they're going to keep going down in the future. I'd rather pay my tax when taxes are lower. So I'm going to defer. Looking at this chart, it makes logical sense to defer my tax, hoping that line, that blue line, keeps coming down over my years, and in my retirement, hopefully I'll be in a lower bracket and all that good stuff. That is the mainstream average way of thinking, but nothing could be further from the truth. Why? The next chart. Government debt is staggering. The last time we were in this much debt, we were fighting World War II. And at the end of the bull market that we just completed in 2019, early 2020, we're facing now a global pandemic with trillion-dollar deficits. How can it be the government is still posting big deficits month over month? It just continues to increase. According to the New York Times, the federal budget deficit swelled to almost $800 billion in 2018, and that was a rise of 17% year over year up through 2018. And those were during the good times before coronavirus. Now in 2020, the budget deficit is going to reach somewhere close to $4.2 trillion by the end of 2020. And that's just this year. What about next year and the next year? And ongoing stimulus talks continue as I record this in late October. So the interest on the government debt alone will soon cost the country more than interest than on our military. That's a big deal. Federal government debt will soon be more expensive than the programs of Medicaid, children's programs, or the military. And within a decade, more than $900 billion in interest payments are going to be due annually, which will outpace every other government program. And at some point, we just have to ask ourselves, what are we going to do with all this debt? What are we going to do to cover the bills when they raise interest rates on us? So by 2020, we're going to spend more on interest than we do on our kids. And isn't the CBO predicting at least $1 trillion deficits every single year for the next decade and beyond? Even before coronavirus hit, we had plans and built right into the recent tax law changes that there would be trillion-dollar deficits over the next decade. Where is our country going to get the money to cover that bill? Will they increase taxes? Or are they going to lower government programs and spending? Or even worse, are they going to just borrow more money? What impact will all that debt have on your financial future? This comes down to you. Your family share is right there on the screen. So ask yourself, where's the government going to get this money? Are they going to take it from people who don't have any money to spend? Are they going to take it from the abject poor? Or are they going to take it from people who have cash? Are they going to raise taxes on those of you who have something to give? Now, let me ask this question. Should you increase or decrease your dependence on your government under these circumstances? And ask yourself, do you think taxes are going to be higher in the future? Now, I like to just ask this question with a simple yes or no. It's not meant to be combative. It's not meant to ask you whether you like the president or Congress or whether you like this program or that program. Just on your particular financial future, do you think taxes are going to be lower or higher? Just a simple yes or no. And what do you think? Do you think taxes even might be way higher than they are today, given all the information I just shared with you, given everything you know about the economy? And finally, big question, most important question, do you want to pay those taxes? I don't presume to know what you want, but most people I meet don't want to wait around and pay a larger tax bill. They'd rather pay their taxes today, get it out of their life, and get on to a tax-free future. Now, most people have a ticking tax time bomb in their portfolio. If you have a 401k, an IRA, or any of the below, a simple ESOP, 457, 403Bs, all of what's on the screen there, you have typically a tax time bomb in your portfolio. What do I mean? The little bit of money that most Americans have saved in those accounts, the 401k, et cetera, what little has been saved will be taxed in retirement. Meaning, if you've got 100 grand in your 401k, you don't actually own all $100,000. There's a good chunk of that belongs to the IRS. If you try to take 100 grand out, watch it turn into 70 grand like that. Again, most common tax postponed plans are on the list here. As I've said before, most CPAs are really focused on helping people reduce this year's tax bill. And that's a good thing. We like CPAs who lower our taxes this exact tax year. That's how they stay employed. If you think about that, they to be liked and they want to stay employed. And so if they can show you how they've lowered your tax bill this year, you will call them next year to do next year's tax return as well. And so mostly they will recommend strategies like tax postponed plans. Tax postponed, that's the word I use. The correct word is tax deferred, but what does deferred mean? It just means put off until later. But the word postponed has a slightly different, more ominous ring to it. Tax deferred is like visiting a dentist. You don't want to defer a root canal. It'll just make things worse. So I want to talk through the story of the farmer and the seed. So imagine for a minute, you're a farmer and you're getting ready to plant the seed for the year, and you're pouring yourself a cup of coffee one early morning and you hear a knock at the door. And in walks an IRS agent, and he sits down and you pour him a cup of coffee. And after a moment you say, "Sir, what are you doing here?" And he looks at you in the eye, he puts down his cup of coffee and he says, "I've been sent here by the IRS and we're going to give you one choice today. And based on how you answer my next question, we will deal with your farm in the way that you answer. You have one chance. Are you ready? Here's the question. Would you want us to charge you taxes on your seed or your harvest?" One answer. What do you say? And you hardly have to wait to answer his question. Immediately you say, "Tax my seed, please. I want my seed to be taxed so I can have a tax-free harvest." And he looks at you, he takes a few notes, he stands up, he walks out the door. As he's grabbing his coat to walk out the door, he looks at you funny and he says, "You said the harvest, right?" And you said, "Yes, I want my harvest to be tax-free, only tax my seed." And he said, "Why is your 401k doing exact opposite to what you want for your farm?" And that is the truth. All of our 401ks are being taxed on the harvest, not the seed. So if you could choose to be taxed on the seed or the harvest, which would you choose? I personally would rather be taxed on the seed and have a tax-free harvest. The harvest is much greater than the seed. And by the way, most economists think taxes are going up. What if I could show you a way to lower your tax bill and even have access to the cash totally income tax-free? Now, I want to quickly, before I do that though, show you guys how most of your 401k is living in a penalty zone for roughly 85% of your life. That's right, 85%. It's not that complicated. Let's say you're 20 years old and you open up your very first 401k. All right. The next 40 years of your life are going to have basically a penalty zone where you can't access that money, or there's going to be a 10% penalty plus taxes to get access to your cash, followed by a 13-year window where there's no penalty, but you still get taxed. And if you live till you're 95, there's going to be another penalty of 50% of cash you should take out but didn't. That's called a required minimum distribution. All in all, the 401k lives in a penalty zone, if you live till the ripe old age of 95, for 85% of this guy's life. It's a tragedy. So I want to talk to you very quickly as we wrap up our quick video together today. Should we defer our taxes and pay them up front, or wait until later and pay our taxes later in retirement? We've got our calculator here, and as promised, I'm going to go back to the question that a client asked me earlier. Again, he was convinced that if he put money into a tax-deferred 401k, he'd have a larger number to earn and grow and invest for his future, and then he'd have more money in his retirement if he let it stay tax-deferred rather than pay his taxes up front. Let's prove once and for all if that matters or not. Okay, so in this case, we've got $100,000, tax rate at 25%, and a growth rate of 6%. I'm going to scroll over here so we can just see the tax-deferred plan here. Let me get rid of this. Go over here for a minute. Let's just focus on only the tax-deferred bucket first, okay? So I'm going to zip over here, expand this a bit. And what you can see here is the $100,000 goes in tax deferred. 100 grand, no taxes due. It was a tax deferred payment. Now we've still got our 100,000, and growth will be based off 100,000. So 6% is $6,000 based on 100 grand. And at the end of the year, we've got 106 grand. And as you can see down the screen here, for 25 years, it grows to a whopping $429,000. Not too bad. right? Not too bad. But when we go to take the money out, he's taxed at 25%, which works out to $321,000. $321,000. Now let's see how much better or worse the Roth account would have done, or any life insurance policy like we work on with Bank on Yourself. Anything that's after tax, like a Roth IRA. You put money into a Roth IRA, first we have to pay our income tax at 25%. So we only have 75 grand to grow for our future, not 100,000. So right away it looks like tax deferred is going to win because we're only growing money on the remaining $75,000. Now over the next 25 years, it grows to, wait for it, $321,000. And that's what you get to walk away with because it's after tax cash. The harvest is tax free. So which of these two won the battle? They were the exact same. And again, like I said, the results are the same no matter what the rate of return is. You can have any rate of return you want. You can have any balance you want. You can have any amount of tax rate you wish. If the tax rate is the same, the results are always the same. The only difference is, what will the future of taxes be when it's time for you to take money out of your retirement account? If you believe taxes are even going to be 1% higher in your retirement, it makes more sense for you to put money into an after-tax vehicle, such as a Bank on Yourself type whole life policy or a Roth IRA. One question: do you think taxes are going to be lower or higher in the future? And as a result of this video, if this has sparked any ideas or questions for you, I'd be honored to chat with you further. Just go to notyouraverageFinancialPodcast.com and click on request a meeting. You can also find the link in the description of the video below and check us out. We'd be happy to chat and answer questions to this point or other questions you might have about your financial strategies going forward. You know, we help folks set up Roth IRAs. We help folks set up Bank on Yourself type policies as well, that all of which can be accessed under current tax law without any taxes due. With that magic in mind, take this to heart. This is an important question, and only you can answer the question, will taxes be higher for me in the future? So whether on the seed or the harvest, I hope to chat with you soon. And thank you for joining me for this little idea bomb, and we'll catch you next time.